Hi all, thank you for visiting. Let's learn more on stock market.
Hey Billy, how are you?
I am doing good, buddy. How about yourself? Come here.
I am doing good, thanks for asking. Can we continue my stock market learning please?
Well, sure. Please ask your doubts.
Which key events that can impact market movements?
Well, Omi, markets and individual stocks react to events. Market participants should equip themselves to understand and decipher these events. Monetary policy is one of the most important economic events. Increasing interest rates curbs inflation and vice versa. The budget is an important market event where policy announcements and reform initiatives are taken. Markets and stocks react strongly to budget announcements. Corporate earnings are reported every quarter. Stocks react mainly due to the variance in actual number versus the street's expectation.
What is monetary policy?
The monetary policy is a tool with which the Reserve Bank of India, RBI, controls the money supply by controlling the interest rates. They do this by tweaking the interest rates. RBI is India's central bank. The world over, every country's central bank is responsible for setting interest rates. While setting the interest rates, the RBI has to strike a balance between growth and inflation. In a nutshell, if the interest rates are high, that means the borrowing rates are high, particularly for corporations. If corporate can't borrow easily, they cannot grow. If corporations don't grow, the economy slows down. On the other hand, when the interest rates are low, borrowing becomes easier. This translates to more money in the hands of corporations and consumers. With more money, there is increased spending, which means the sellers tend to increase prices, leading to inflation. In order to strike a balance, the RBI has to consider all the factors and should carefully set a few key rates. Any imbalance in these rates can lead to economic chaos. The key RBI rates that you need to track are as follows. First is repo rate. Whenever banks want to borrow money, they can borrow from the RBI. The rate at which RBI lends money to other banks is called the repo rate. If the repo rate is high, that means the cost of borrowing is high, leading to slow growth in the economy. Markets don't like the RBI increasing the repo rates. Second is reverse repo rate. Reverse repo rate is the rate at which RBI borrows money from banks. When banks lend money to RBI, they are certain that RBI will not default, and hence they are happier to lend their money to RBI as opposed to a corporate. However, when banks choose to lend money to the RBI instead of the corporate entity, the supply of money in the banking system reduces. An increase in reverse repo rate is not great for the economy as it tightens the supply of money. Third will be the cash reserve ratio, CRR. Every bank is mandatorily required to maintain funds with RBI. The amount that they maintain is dependent on the CRR. If CRR increases, then more money is removed from the system, which is again not good for the economy. The RBI meets every 2 months to review the rates. This is a key event that the market watches out for.
What is inflation?
Well, inflation is a sustained increase in the general prices of goods and services. Increasing inflation erodes the purchasing power of money. All things being equal, if the cost of 1 kilogram of onion has increased from 15 rupees to 20 rupees, then this price increase is attributed to inflation. Inflation is inevitable, but a high inflation rate is not desirable as it could lead to economic uneasiness. A high level of inflation tends to send a bad signal to markets. Governments work towards cutting down the inflation to a manageable level. Inflation is generally measured using an index. If the index is going up by certain percentage points, then it indicates rising inflation. Likewise, index falling indicates inflation cooling off.
Okay, what is index of industrial production?
The index of industrial production, II, is a short-term indicator of how the industrial sector in the country is progressing. The data is released every month, along with inflation data, by the Ministry of Statistics and Program Implementation, MOSPI. As the name suggests, the II measures the production in the Indian industrial sectors, keeping a fixed reference point. As of today, India uses the reference point of 2004 to 2005. The reference point is also called the base year. Roughly about 15 different industries submit their production data to the ministry, which collates the data and releases it as an index number. If the II is increasing, it indicates a vibrant industrial environment as the production is going up, and hence a positive sign for the economy and markets. A decreasing II indicates a sluggish production environment, hence a negative sign for the economy and markets.
That's helpful. What is Purchasing Managers Index?
The Purchasing Managers Index, PMI, is an economic indicator that tries to capture the business activity across the manufacturing and service sectors in the country. This is a survey-based indicator where the respondents, usually the purchasing managers, indicate their change in business perception with respect to the previous month. A separate survey is conducted for the service and the manufacturing sectors. The data from the survey are consolidated on a single index. Typical areas covered in the survey include factors such as new orders, output, business expectations and employment amongst others. The PMI number usually oscillates around 50. A reading above 50 indicates expansion and below 50 indicates a contraction in the economy. And reading at 50 indicates no change in the economy.
And what is budget?
A budget is an event during which the Ministry of Finance discusses the country's finance in detail. The finance minister on behalf of the ministry makes a budget presentation to the entire country. During the budget, major policy announcements and economic reforms are announced which has an impact on various industries across the markets. Therefore the budget plays a very important role in the economy.
What about corporate earnings announcement?
Well, it's simple. This is perhaps one of the important events to which the stocks react. The listed companies, trading on stock exchange, are required to declare their earning numbers once in every quarter, also called the quarterly earnings numbers. During an earnings announcement, the corporate gives out details on various operational activities including 1. How much revenue the company has generated. 2. How has the company managed its expense. 3. How much money the company paid in terms of taxes and interest charges. 4. What is the profitability during the quarter. Besides, some companies give an overview of what they expect from the upcoming quarters. This forecast is called the corporate guidance.
Okay, then what is?
Well, only let's connect during next session. Have some task at hand.
Thank you, Sergi, for today's session.
My pleasure.
Please like this video.
Please share this video. If you have any doubts, comment on it.
If you want more such learning videos, please subscribe to this channel.